Welcome to this week's Market Matters video update. Thanks for joining me, James Gerrish. It's Harry Watt here on Wednesday, the 19th of January. Today, market's been a bit choppy the last week or so, Jimmy. Interest rates and bond yields are the talk of the town at the moment. What is MM's position in this respect?
Yeah, hello, Harrison, and hello, viewers out there for this week. We have had a pretty choppy week, and it came, we came in this morning and the US market was down sort of 500 odd points on the Dow, so we're expecting a pretty negative session on the market. We've done pretty well today. We're actually, as we speak, we're down 30 points on the ASX, and that it sort of speaks to the underlying resilience on the market. So our view at the very short term, our view at the very start of the year is the markets can still push higher. You spoke about bond yields, and it's certainly the topic on everyone's lips at the moment. Interest rates are going high. We're seeing it. We've seen it throughout last year, and we've seen it now at the start of this year. The market's now pricing in 4 interest rate hikes in the US in 2022. So the target Fed funds rate at 1% by year end. So that's now priced into the market. We did our 2022 outlook piece this week, and one of the things that we raised was around the market being now very much in the consensus that interest rates will go higher and therefore bond yields will go higher. I suspect that we're probably near a peak in bond yields. So I think that consensus trade, the majority of consensus trades often prove to be incorrect. And I think that could be one of them. So that has implications from a sector point of view and how we'll be sort of managing portfolios throughout the year, Harry.
Yeah, definitely. You sort of talked to moving a bit more defensive in terms of positioning of the portfolio. You made one move last week in that respect, James. How are we going to see this play out in terms of MM's portfolios, and are you concerned about the market where it is right now?
I don't want to push this concerned approach. So, the market, I think this year will be more challenging than it was last year, but last year was a really strong year. The reason I talk about that, or we're writing about that, is basically around peak policy support. So by that I mean, record low interest rates, and they can only go one way. Record amounts of stimulus in the system, which is creating a huge pool of liquidity, which is pushing asset prices higher. So while on one side the economic momentum remains strong, on the other side we're seeing sort of central banks and government sort of reducing the punch bowl for asset prices. So that's why I'm suggesting this year that there will be a point in time. I don't think we're there yet, but I think there will be a point in time this year that we need to turn more defensive. I don't think it's about going to huge levels of cash. It is going to a bit more cash because we're fully invested across our portfolios at the moment, but it's holding stocks and securities that are more defensive in nature. So they've got more defensive earnings. They're not as high beta as perhaps some of the positions we've got in the portfolio at the moment, Harry. So there'll be a noticeable transition within portfolios as the year progresses, or that at least that's our view at the moment from what we're seeing.
Yeah, definitely. Moving on to a bit more stock specific, and one that's definitely a high beta stock is Hub24. They were out with a quarterly update today, James. Pretty strong, and they're sort of outperforming on a weekday on the market. What's your take on this one?
Yeah, they are. They're up 2.5%, or just a bit over 2%, I should say, as we're recording this afternoon. So they came out, as you said, a really strong quarterly. They had net flows into their platform for the quarter of 3.6 billion. So just consider that for a little bit. 3.6 billion over a 3-month period. That's incredibly strong flows. Our analyst who covers the stock is looking for 2.4 billion. So it's a big beat on his numbers. They've now got funds under administration, FUA of 50 billion on the platform, and that's up 128% year on year. So, and we saw in your portfolio, Harry, Praemium give an update at the back end of last week, which was really strong as well in terms of their fund flows. So we're seeing these independent platforms really attract funds under administration. It is a really strong growth area. I know we've written a lot about being our tech exposure and the influence of higher interest rates on technology. But you think of these platforms, they're businesses that benefit from scale, and Hub is getting a lot of scale. So we certainly like that one. It's trading at 27.49 at the moment. So yeah, we like that one, Harry, after a really strong quarterly.
Another one that had an update today was BHP, James. If we look sort of 6 months out, that's going to be a completely different stock. We've got the unification process coming up. That vote will be in the next week or so. You've got the merger of the petroleum business out to Woodside sort of later in the quarter into the second quarter of this year. James, what was your take on the December quarter update, though?
Yeah, all of those points, Harry, are spot on. So just in terms of the quarterly they did today, everything was in line, but I don't think that's the main story in BHP. You touched on the high notes there. I think ultimately BHP is going to be a different beast in the years ahead. They talk a lot about future-facing commodities and gaining exposure to future-facing commodities that will be, things that are going to be involved in how we source power, how we feed expanding populations and the like. The unification of BHP structure, so the London listing winds up and we only have a primary listing in Australia. That means there's going to be an index implications there. We wrote about this morning that BHP will go from sort of 6% of the index to near 10% of the index. I think that ultimately how we'll play it, we've got large positions in BHP across three of our portfolios, I should say. If we get a squeeze up into this unification, we might lighten the load into that. So BHP is sort of trading around that $47 mark at the moment. We think it'll trade above 50 in the short term. If it does, that squeezes up, then we'll be on the view of lightening our load in BHP into that strength.
Yeah, definitely. Finally, James, I'm going to ask you to stick your neck out a little bit. Pick out sort of three stocks you'd be buying here for the MM portfolios and for the subscribers.
Yeah, it's a always difficult question, just highlighting three. So there's one of the questions we often get through the information pipe through the chat function on the website that subscribers can go and utilize is what stocks can I buy here and now? And if you go into the Market Matters portfolios, there is a tab marked active next to stocks that we're still happy to buy at current prices. So that would be your first point of call. Three I'd pick out is right here and now, Santos. I like the look of the energy sector here. Oil prices are breaking out. The energy sector is lagged. One of the more highly leveraged plays on the energy sector or the price of energy is Santos. So we like Santos here. The other one was Hub, obviously, after a very strong quarterly update today. Very much like that. It's at the bottom of its range. And I like, I'd be a buyer of Hub at these current levels. And I'll probably wrap it up with Virgin Money. I know it's not that exciting. It has run up a bit from recent lows. It's trading around 360. But to me, that's got $4 all over it in the very short term. So they would be three. But there's, I'd implore people to go onto the Market Matters website, look at the relevant portfolios that interest them, and look for the active tabs next to the stock codes. And you'll see if we're still happy to buy that particular stock at current prices, Harry. Yeah,
definitely. Thanks for that, James. Great update today. We'll get back to this market, which is bouncing around everywhere at the moment, isn't it?
It is. We're down 0.5%, so down 36 points. It is a bit of a volatile day, but I think that's the message that viewers need to take out of this year. I think this year is going to be volatile, hence our sort of movement more towards defensive holdings. But also we're going to probably be a little bit more nimble in our portfolios throughout the next 12 months or so. So keep an eye out for alerts as we progress.